Welcome to Breaking News to Trading Moves. Today we're looking at a pretty pivotal development in the tech sector, the accelerating demand for AI-driven networking solutions.
That's right. And the material we've been looking at really centers on Arista Networks, that ticker ANET. And really, its market position kind of gives us a window into where capital is flowing across the whole technology landscape.
So our goal here is to really lay out which companies and which market segments are positioned to gain and, which ones might be facing some pressure because of this whole new requirement for AI networking.
Exactly. It's a massive new requirement.
Okay, so let's get right into the core idea. We're essentially looking at a market rotation, trying to figure out who wins when the underlying technology that powers AI, the hardware layer, gets a major overhaul.
And this whole conversation, it really orbits around one central theme: the rising demand for sophisticated, really intelligent network infrastructure. You need it to handle these intense AI workloads, especially inside these massive hyperscale data centers.
Right. This isn't just about a simple upgrade. It feels more like a necessary architectural redesign.
That's the essential point. The network fabric, you can think of it as the internal plumbing connecting all the servers and compute units. It's always been important, but AI has just raised the stakes to a whole new level.
How so?
Well, AI workloads, whether you're talking about training a large language model or running inference tasks at scale, they need two things from the network that are just non-negotiable: incredibly low latency and massive, sustained, and this is key, lossless bandwidth.
Lossless bandwidth between potentially thousands of GPUs.
Thousands of them all working together.
So why is latency suddenly a matter of, economic life and death? We've always heard about it for things like high-frequency trading, but now for training models.
Well, think about what it takes to train a single large model. That model is split up across maybe hundreds, maybe thousands of GPUs.
Okay.
And every single time those GPUs finish a calculation, they have to communicate and synchronize their results across the entire cluster, and they have to do it instantly.
So any delay is a problem.
A huge problem. If there's even a millisecond of delay, or worse, if a packet of data gets dropped in the network, that incredibly expensive hardware, we're talking millions of dollars per rack, it just has to stop and wait.
And that wasted time means lower utilization rates for assets that cost a fortune.
Exactly. And the model training slows down dramatically. The efficiency of the network, it directly dictates the return on investment for the entire AI cluster.
So we're talking about optimizing that server-to-server traffic, or I guess GPU-to-GPU traffic.
That's it.
And that's fundamentally different from the old north-south model, which is just a user accessing a server.
It's the complete opposite. Traditional data centers were built for that north-south traffic, which is kind of bursty. It involves human interaction. AI clusters demand immense, constant, east-west traffic flow.
And how do they achieve that?
They often rely on specific protocols. One is called RDMA over Converged Ethernet, or
Way.
And what ROCE does is it's designed to bypass the operating system to allow direct memory access between GPUs, which just slashes latency. But, here's the catch, ROCE requires what's called a lossless fabric.
Meaning no dropped data packets at all.
Not one. In a traditional network, if a packet drops, the software just retransmits it. No big deal. In an AI fabric, a dropped packet is catastrophic. It halts the whole synchronization process and grinds that multi-million-dollar GPU cluster to a standstill.
And that necessity for a perfectly managed, high-speed lossless fabric is where Arista Networks comes in.
That's what they specialize in.
Okay, so let's establish the focal point. Arista Networks, ticker ANET. They're really seen as the embodiment of this evolution. They're building the solutions that specifically address these ROCE and lossless fabric needs at a huge scale.
And their position is very advantageous because they've always focused on hyperscalers and cloud operators. That's different from some of the legacy vendors who are more geared towards standard enterprise networking.
So they were already in the right place, so to speak.
They were. And their architecture, which often uses what's called merchant silicon instead of just proprietary chips, it gives them flexibility. It gives them speed in adopting the latest, highest bandwidth components. And that is absolutely necessary when your bandwidth needs are doubling every year.
Speaking of their tech, the information we looked at highlights a platform called VESPA. This seems to be an example of the kind of intelligent solution that's in demand right now.
It is, but it's important to clarify what that means in this context.
Right, because just hearing Wi-Fi roaming makes it sound a little too simple for a hyperscale AI data center.
That is a crucial clarification. Yes, Some of Arista's portfolio handles campus and Wi-Fi management. But the broader point of a platform like VESPA, when you think about AI infrastructure, is its role as an intelligent control plane. It's a network telemetry tool.
So it's about moving beyond just selling hardware.
It's about delivering solutions that automate, monitor, and manage how resources are allocated across these incredibly complex, high-demand environments.
Can you break down what management at scale really means for an AI cluster using a platform like this?
It's all about proactive problem solving. It's about quality of service assurance. If you have 100 racks full of GPUs, you're talking about hundreds of millions of dollars of infrastructure.
Can't afford for it to go down.
You can't. So VESPA and similar intelligent platforms, they are continuously monitoring every single flow across that network fabric. They're looking for congestion, for microbursts, for any little deviation that could lead to a dropped packet and freeze the whole AI job.
It's the intelligence layer that guarantees everything keeps running.
It guarantees throughput and continuous operation. So, for example, if a big cloud provider sets up a new 1,000 GPU cluster for a client, they rely on platforms like this to promise that client that performance won't degrade. That ability to automate quality assurance at hyperscale is what makes solutions like Arista's so valuable.
And that's why we're seeing investment capital rotate toward companies that provide this level of control and intelligence.
That's the whole story right there.
That sets the stage perfectly. So we understand AI requires this specialized, ultra-high performance infrastructure, and Arista is providing a blueprint for it. Now, let's pivot to the market segments that are set to gain the most from this.
Okay, we can really break the beneficiaries down into three interlocking groups. Each one is benefiting from this explosion of capital expenditure in AI infrastructure.
So our first major category of winners would be the AI networking and data center infrastructure providers.
Right, and the thesis here is pretty straightforward. These are the companies providing the shovels and pickaxes for the AI gold rush. They offer solutions built for these demands, and they benefit from every dollar spent on upgrading network fabric in data centers.
And of course, the company at the center of this conversation is Arista Networks, ticker ANET. They're providing the AI-enabled networking solutions that are, in many ways, setting the performance standard.
They are.
What's the technical advantage that lets them sustain this lead, especially against some massive competitors?
Arista has maintained this agile advantage through two main factors: their reliance on merchant silicon and their extensible operating system, or EOS.
Okay, merchant silicon, so using commercially available chips.
Exactly. From companies like Broadcom, instead of spending years developing their own proprietary chips like some competitors, they can rapidly integrate the newest, fastest chips into their switches. This means they consistently offer higher port density and more bandwidth sooner than their rivals.
And the operating system, EOS.
Their EOS platform is highly programmable. This makes it much easier for the hyperscalers who operate at a scale that's just far beyond standard enterprise IT to integrate Arista's gear into their huge customized orchestration systems. They've really cornered the market on providing reliable, high-speed switching for these open, automated cloud environments.
But the demand is so huge, this can't be a one-company show. The material also includes Cisco systems, ticker CSCO, in this winner category. Now, that seems a bit counterintuitive, especially since we'll see them on the other list later.
It does.
So how does an established giant like Cisco compete here?
That segmentation is critical. It really shows the complexity of a legacy tech company. Cisco is a winner specifically through its high-end portfolio. We're talking about their platforms aimed at hyperscale and cloud AI, like their Nexus line, which has been adapted for ROSI and AI workloads.
So they're leveraging their existing strengths.
They are. Their massive installed base, their deep engineering resources, and decades of trust with data center operators. They might move slower than Arista, sure, but their ability to provide global support and financing for these multi-billion-dollar build-outs makes them a necessary partner for the biggest cloud operators. When a hyperscaler needs hundreds of thousands of ports, like yesterday, Cisco can deliver that scale.
And rounding out this core infrastructure group is Juniper Networks, ticker JNPR. What's their specific angle here?
Juniper, especially after acquiring Mist, is really focused on the operational efficiency side of things, using AI-driven automation within the network itself.
So while Arista is focused on the raw speed of the fabric,
Juniper is providing AI tools to make operating and maintaining these huge, complex networks simpler. Their inclusion here reinforces the idea that AI clusters don't just need systems that move data fast, they also need systems that require fewer human engineers to manage them.
Right. For the cloud companies, any reduction in operational expense, or OpEx, driven by smart automation, is a massive win.
A huge win.
Okay, that covers the providers of the network plumbing. Now for the second group of winners, the companies making these huge capital investments to house all this new gear. We're talking about the cloud and hyperscale data center operators.
And this group includes Amazon, ticker AMZN, Alphabet, which is GOOGL, and Microsoft, MSFT.
These companies are the direct beneficiaries. They rely on these upgraded networks to deliver their services and really to capture market share in the whole AI services space.
That's the game right now.
But here's the question. If they're spending billions buying the gear from Arista and Cisco, why are they considered winners? Doesn't that huge capital expenditure, the CapEx, hurt their margins?
You know, it's the ultimate example of a necessary value-accretive investment. Spending on AI-ready network fabric isn't a drag on the business. It's a critical competitive necessity. And it yields a high return.
How so?
Well, if their network can train a large language model 20% faster than a competitor's, that translates directly into lower internal costs, a faster time to market for new AI features, and the ability to charge a premium for superior AI services they offer to enterprises.
So the return is multifaceted. Lower internal costs through efficiency and higher external revenue from premium performance-guaranteed services. They're essentially building a moat.
Precisely. They are monetizing speed and reliability. Think about an enterprise that's using Microsoft Azure's AI offerings, that's MSFT. That customer is willing to pay a lot more for guaranteed low-latency access to inference and fine-tuning services.
And the ability of Amazon, AMZN, and Alphabet, GOOGL, to provide that same superior performance is entirely based on the quality of the networking they deploy.
It's all underpinned by that. This massive investment reinforces their dominance in the cloud space, cementing them as clear winners in this cycle by creating huge barriers to entry for any smaller cloud providers.
Okay, our third winning segment provides the computational power that these networks connect, the semiconductor and GPU providers. This is a classic supply chain interdependence.
Exactly. The AI networking trend significantly boosts demand for the underlying processing hardware, and it justifies the very high price tags on that hardware.
Leading this category, of course, is NVIDIA, ticker NVDA, known for its high-performance GPUs. But we also see advanced micro devices, AMD, and Intel, INTC.
The relationship here is all about maximized utilization. AI workloads need massive parallel processing, and that's what high-end GPUs provide.
And as the networking solutions from someone like Arista eliminate that network bottleneck.
They enable the deployment and, critically, the effective utilization of larger, denser AI clusters. If a cluster's network fabric is slow or unreliable, the GPUs spend too much time sitting idle.
Wasted potential.
Exactly. By improving network efficiency, Arista's technology ensures that the expensive silicon from NVIDIA, NVDA, and AMD is running at near 100% utilization.
So better plumbing justifies buying more expensive and more of the high-performance chips.
That's the key economic driver. A hyperscaler's CapEx decision is a complex equation, but if they know their networking vendor can provide a lossless fabric that guarantees, say, 99% GPU uptime during a training run, they are much more likely to invest heavily in the newest, most expensive GPUs, like the NVIDIA H200s or the AMD MI300s.
And where does Intel, ticker INTC, fit into this? They're more known for CPUs, not the high-performance GPUs that are driving this boom.
Intel plays a critical role on two fronts. First, they supply the necessary CPUs that handle all the supporting tasks in the data center that aren't those parallel AI workloads, things like orchestration, data prep, and just traditional server functions.
And the second front.
They're also a key supplier of other networking components. Think silicon for network interface cards or NICs, and specialized interconnect technologies. Their inclusion here confirms that the entire hardware ecosystem, CPUs, GPUs, controllers, it all benefits when AI cluster deployment becomes scalable and reliable because of advanced networking. Their fortunes are intrinsically tied to this.
That provides a really comprehensive picture of the upward momentum. We have the plumbing providers, the cloud operators who buy and use that plumbing, and the silicon providers who benefit from the maximized usage of their chips.
Right.
Now let's transition to the other side of the coin, the market segments that are facing potential headwinds or where investor attention might be rotating away from.
And this transition is crucial because it's really a story of relative performance and capital prioritization. These companies aren't necessarily facing extinction, but they are positioned in slower growth areas compared to the explosive capex being directed at AI infrastructure.
Our first category facing exposure is traditional enterprise networking vendors.
The underlying premise here is that firms focused on older or more established networking solutions, the kind optimized for office campuses and standard IT workloads, they may just experience significantly slower growth compared to those concentrating on the bleeding-edge, high-performance AI-capable networks.
The companies listed here include Hewlett-Packard Enterprise, that's ticker HPE, and Finisar, FNSR. And as we mentioned before, we see Cisco Systems, CSCO, listed again, but specifically their older enterprise lines.
That distinction within Cisco is the clearest illustration of the problem. While their high-end Nexus line is a winner in the hyperscale AI fabric space, their huge installed base in legacy enterprise hardware is facing a valuation drag.
So investors are looking for that pure play AI exposure.
Exactly. And companies like Hewlett-Packard Enterprise, HPE, which has a broad traditional focus on servers and standard enterprise switching, they're facing a portfolio rotation challenge. Their growth is tied to the standard IT budget cycle, which is stable, but it lacks the explosive growth potential of these AI infrastructure buildouts.
So it's not that their revenue is crashing. It's that their investor multiple suffers because the market is prioritizing exponential AI revenue growth over stable, traditional enterprise revenue.
You've hit it on the head. Investor focus is rotating heavily toward these AI-first providers. A firm like Finisar, FNSR, which is often involved in specialized optical components for legacy telecom and standard data center interconnects, they risk being seen as behind the curve if their products aren't explicitly optimized for the latest ultra-high-speed AI protocols, like those used in ROCE environments.
The market isn't just demanding speed, it's demanding AI-optimized speed.
That's the new benchmark.
Moving on to the second category facing exposure, smaller AI infrastructure startups. This group includes Finisar, FNSR again, IPG Photonics, ticker IAPGP, and Marvell Technology, MRVL.
The difficulty for smaller players is really driven by consolidation and risk aversion at the top of the supply chain. When Amazon or Microsoft decides to build a data center, they are spending billions, and system reliability is absolutely paramount.
They can't afford to experiment with an unproven vendor.
No way. They prefer the established players, Arista, Cisco, Juniper, who can offer comprehensive, globally supported, and proven systems integration.
So that suggests that even if a smaller company has technically superior components, the sheer capital and system integration needed for a new data center fabric favors the bigger, more established providers.
That is the challenge. Marvell Technology, MRVL, is a critical component supplier. They provide custom silicon for switches, networking chips, specialized connectivity solutions. They're technically essential. But in this market snapshot, they are grouped among those facing consolidation pressures because investors are rewarding the companies that build the entire system, not just the components inside it.
And what about IPG Photonics?
Similarly, IPG Photonics, IPGP, which focuses on advanced optical solutions, may struggle to translate their technical superiority into massive contracts if they lack that broad systems integration capability that hyperscalers demand for standardization. The market consolidation just limits the growth opportunities for these emerging component providers in favor of the integrated system vendors.
Finally, let's look at the third category of companies facing exposure. Non-AI focused data center vendors. These are the owners and operators of the physical real estate itself.
And their exposure relates directly to the physical limitations of their facilities. The companies listed here are Digital Realty, ticker DLR, Cyrusone, CONE, and Equinix, EQIX specifically. They're segments with lower AI adoption readiness.
Why does AI networking pose such a physical constraint on the real estate side? It's not just about needing more space, is it?
It's far more complex than just space. It's about power density and cooling.
Okay.
A traditional enterprise IT rack might consume, 5 to 10 kilowatts of power. An AI cluster rack packed with high-end GPUs can consume 50, 75, even 100 kilowatts per rack.
Wow, that requires entirely different infrastructure.
Completely different power delivery, electrical systems, and most critically, cooling mechanisms. Standard air-cooled data centers simply cannot handle that level of heat density without very expensive and often impractical retrofitting.
So if a facility owned by Digital Realty, DLR, or Cyrusone, CONE, hasn't been reconfigured with, say, liquid cooling or extreme power infrastructure, they're facing the risk of stranded assets.
Absolutely. The core rationale is that data center operators who have lagged in making these necessary physical upgrades will see clients migrate to competitors who have invested in AI-optimized real estate. These older facilities become stranded assets because their highest growth customers, the AI cluster builders, simply cannot use them.
The client will inevitably go to providers who have already made the necessary upgrades.
They have to.
And for a massive global operator like Equinix, ticker EQIX, how does this manifest for them?
Equinix has a vast global footprint, and much of it is dedicated to standard co-location services, traditional interconnection and enterprise IT. While they are actively building out AI-ready capacity, their challenge is the sheer size of their legacy portfolio.
So investors are looking at the percentage of their portfolio that's AI ready.
That's right. And the segments with lower AI adoption are facing a lower relative valuation growth rate compared to the pure-play, high-density AI infrastructure providers. It forces them into a very expensive and very urgent CapEx cycle to retrofit or rebuild.
So we have a clear picture of how market capital is being redistributed. It flows toward the enablers of this new high-performance fabric Arista Networks, ANET, Cisco CSCO high-end segments, and Juniper JNPR.
It rewards the major operators, Amazon, AMZN, Alphabet, GOOGL, and Microsoft MSFT, who use this fabric to build their competitive moats.
And finally, it benefits the underlying hardware suppliers, NVIDIA, NVDA, Advanced Micro Devices, AMD, and Intel INTC, who see their utilization rates soar.
And conversely, capital rotates away from firms that are focused on legacy enterprise IT, like Hewlett-Packard Enterprise, HPE, and Cisco's CSCO legacy lines.
And away from component providers who are facing consolidation pressure, Finisar, FNSR, IPG Photonics, IPGP, and Marvell Technology, MRVL.
And finally, away from the physical real estate operators who have lagged in preparing for the extreme power demands of AI, like Digital Realty, DLR, Cyrusone, CONE, and the non-optimized segments of Equinix, EQIX.
This entire discussion raises one final thought for you, the listener, to consider. We've established that the shift in performance requirements for AI is the singular driver of this market rotation. So what if the rapid adoption of AI-ready networking and this need for 50-plus kilowatt racks becomes the baseline expectation rather than a premium service?
And given the speed at which hyperscalers are deploying this technology, that seems likely.
So the question is, how quickly will the firms we listed as facing exposure be forced to accelerate their infrastructure upgrades just to avoid long-term stagnation? The cost of waiting seems to be rising faster than the cost of modernization itself. This is not financial advice or buy or sell recommendations. This is purely the opinion of the author.